Today's topic is about depreciation. Our lesson objectives are as follows: explain the causes of depreciation, distinguish between straight line and reducing balance method of depreciation, calculate and record in the books of accounts, calculate and record profit or loss of non-current assets. To get started with, depreciation is a very important part of accounting. There are two methods of depreciation: straight line and reducing balance. Depreciation is linked closely to accounting concept of consistency and accruals. Let's look at an activity. Look at your list of non-current assets and order them according to which will depreciate or lose their value more quickly. Why do you think non-current assets will have different valuations for depreciation? Write some of the non-current assets increase in value in the future. Now you're at home and you can find some non-current assets which you can use it for more than a year. So guess some of them and identify which one do you think will lose its value quickly. And for example, in the second case, there are certain non-current assets which its value will increase in the future. For example, land. When you're starting your work in your notebook, or you can use this Excel sheet which I had created for you and shared in Google Classroom, as well as I had shared it in Microsoft Teams in Class Notebook. Now, write the topic, lesson objectives. These are the lesson objectives. And we are starting with the lesson objectives and listing down the vocabulary. Once you're done with the vocabulary, I would expect you to define what is depreciation. It is the reduction in the value of non-current asset over time due in particular to wear and tear. Wear and tear means it gets worn out. What could be the causes of depreciation? So here there are few examples given, or the causes of depreciation. Take few minutes to read. Moving back to your textbook, again you have information about non-current assets such as machinery, motor vehicle, plant and equipment tend to fall in value, depreciate for various reasons. These reasons described more fully below. One of the reasons could be physical depreciation. One of those are wear and tear, where it gets worn out. Second reason, erosion, rust, rot and decay. Equipment may be eroded or wasted away by the action of wind, rain, sun, or the other elements of nature. The metals in motor vehicle or machinery will rust away, wood will rot eventually, decay is process caused by the elements of nature and a lack of proper attention. The second main reason could be due to economic factors. Economic factors are the reasons for an asset being put out of use even though it is in good physical condition. The two main economic factors are obsolescence and inadequacy. Let's move to the next page. Obsolescence. This occurs when an asset becomes out of date due to advanced technology or a change in process. For example, in the car industry, much more of the assembly work is now done by robots. Computer hardware and software tend to go out of date very quickly and need updated and replacing regularly. Inadequacy. This arises when an asset is no longer used because of the growth and change in the size of business due to new regulations. The transport industry is now able to use much larger vehicle than before, resulting in many businesses selling off their smaller vehicles. Time factor. Some assets have a legal life fixed in terms of years. For example, a lease. A business may decide to rent a property for 10 years, so it takes out a lease. A legal agreement is drawn up between the parties. Each year, a proportion of the cost of lease is depreciated until the lease expires and the value is nil. In such cases, the term amortization may be used instead of the term depreciation. Depletion. Some assets are of a wasting nature, such as the extraction of raw materials from mines and quarries or oil from oil wells. Such natural resources are often sold in their raw state to other businesses for processing. Providing for the consumption of an asset of a wasting character is known as provision for depletion. Now we are moving into the main part of calculation of depreciation. So when we move to method of calculation, there are two methods which is in line with your curriculum, straight line method and reducing balance method. Under straight line, there are two formulas which you're supposed to apply. Now let's see a question. We are doing a question for straight line method. Under straight line method, there are two formulas. One is you take the cost, you take away your scrap value, and then you divide this by the useful lifetime. Now, this is one formula which you can use here. And this is formula 1. Now, let's look at another example. Okay, there are two methods of calculating depreciation using straight line method. One of the method is using formula 1. Cost take away scrap value. Scrap value is the amount that an asset can be sold after its useful time, and useful lifetime is for how many years you can use a non-current asset. And formula 2, cost times the percentage. Now it depends on the type of question whether to apply formula 1 or formula 2. Now let's look at an example where you might have to use the first formula. 1st of Jan 2000 machinery at cost 100,000. 31st 12 2000 machinery scrap value is 2000 and its useful lifetime 10 years. Now let's apply to the formula. The cost is 100,000 and the scrap value 2000 and its useful lifetime 10 years. First of all, you find the difference between the cost and the scrap value, which gives you an answer of 8,000. and then you divide this by the useful lifetime, 10 years. Therefore, the answer for the amount of depreciation of this machinery per year or per financial year would give you an answer of 800. Now let's move back to the second formula, cost times the percentage. So here the cost of the machinery is 100,000 and the percentage 10%. That means 10 divided by 100. And then you find the answer. Therefore, you get an answer over here which is worth 10,000. Now, you're very clear in using both the formulas under Straightline method. Straightline method of depreciation. Now you can complete this either in your notebook or in the Excel sheet and submit your work in the assignment in Microsoft Teams. Or you may complete it in written in your notebook and you can insert or you can copy paste the images into your notebook in Microsoft Teams. Now let's look at an example of how you're going to post the second formula to the ledgers. Now moving back to the double entries, you should be very clear with the double entry of current year's depreciation. You debit income statement and credit non-current provision for depreciation account. Just now we did a calculation for straight line method. Let's apply and see to the straight line method of the example that we did right now. And we are doing it only for the year 2000. So the non-current asset is machinery and the cost of machinery 100,000. 10% is the depreciation percentage, whereas you get 10,000 as the current year depreciation. I'm going to remove it for the next year because we are not calculating it right now. Now let's see how this is going to impact in a provision for depreciation account. For the moment, I'm marking 0, right? At the beginning of the year, there wasn't any depreciation. For the year that you calculated was 10,000. Therefore, when you balance it, you can find the credit side is greater. Therefore, you carried down 10,000, brought down 10,000. Now you're done posting these entries to the provision for depreciation ledger in the machinery account. Let me explain one more time how to balance the ledger. Credit side is greater, bring the 10,000 here, 10,000 here, take away 0 gives you 10,000, which is 31st 12 2000 balance carried down. There isn't any disposal during the year, so either you can ignore this or you can write it and mark a 0. 1/1/2001 balance brought down 10,000. Now once you're done with this, there are two financial statements that we prepare. One is income statement and another one is statement of financial position. Now how are we going to show this in an income statement? So in an income statement, I have just given an extract, and these are the possible information which will come in relation to depreciation. You less expense and you're writing the entries only for 31st 12 2000 machinery depreciation and the value that you calculated for the current year. Moving back to the statement of financial position, calculation for the year 2000, non-current asset machinery cost 100,000, and then your accumulated provision for depreciation is 10,000 for the current year. So make sure you show this within the brackets, this 10,000. And then your net book value will be 90,000. Now, we'll assume you're expected to do the calculation for the second year as well, which is 2001. So you didn't purchase or sell any machinery. Therefore, your cost of the machinery will remain the same. Percentage remains the same because it's straight line method and it's a policy by the business. Therefore, the second year also the calculation remains 10,000. Now, when you're posting this entry, you will post it in the provision for depreciation account 31st/12/2001 income statement expense 10,000. Now you can see your credit side is greater, 10,000 plus 10,000 gives you 2,000, 20,000. Bring the 20,000 here, 31st/12/2001 balance carried down 20,000, and then bring it down to the credit side as 1st of Jan 2002 balance brought down 20,000. And remember, wherever you write balance brought down, these information will usually go to the statement of financial position. Now let's see how this is going to reflect in the income statement. Now you can see 31st/12/2001 machinery depreciation has been posted as 10,000. And in the second statement of financial position, you can see the machinery cost is 100,000, but we have taken the total 20,000 for 2 years accumulated depreciation. Therefore, 100,000 take away 20,000 gives you 80,000 as the net book value, NBV, net book value. Now, today we had learned how to calculate depreciation using straight line method, definition of depreciation, and the causes of depreciation.